Hello everyone. Welcome to another episode of CA with CA, Current Affairs with Chartered Accountant. Myself, CA Anakha Anjani Tekekara, and together let us discuss the current affairs of the Indian economy. In today's video, we will be discussing about a much discussed topic in the banking sector, non-performing assets or NPA. So why was this in news? Banks' NPA ratio likely to fall to 5 to 5.55% by March 2024, says S&P Global, a credit rating agency. Even though we've read this term many times in the newspapers, do you really know what it means? In the perspective of a bank, an NPA is that asset, that is a loan or an advance, for which the interest or principal or both is overdue for a period of 90 days or more. So what does that mean to the bank? It means that there is no income getting generated from that asset for the bank, and hence it is termed non-performing. So you guys know that the business of a bank is to accept deposits and to lend money. When you lend the money for a bank, it is the asset. There is no income getting generated from the assets. How will you repay back your deposits? Many a times, this problem leads to the failure of banks. Hence, RBI has put in strict regulations when it comes to non-performing assets of the banks and mandates the banks to foresee its losses and provide a provision in the balance sheet. Provision is nothing but an amount kept aside in the balance sheet of the bank under its liability side so that the asset value is reduced. So, how much should a bank keep aside for its non-performing assets? It all depends upon the period and particular asset has been an NPA. Based on that period, there are three classifications for an NPA. The three classifications are substandard, doubtful and loss assets. Substandard assets are those assets which have been an NPA for up to 12 months. Doubtful assets are those assets which are NPA for a period from 12 months or say it can be up to 3 years or more. Now, a loss asset is that asset which has little realizable value as certified by the bank's internal or external auditors or by RBI itself. Now, based on these classifications and the duration of the NPA, provisioning can vary from 0.25% to all the way up to 100%. Provisioning coverage ratio indicates the total amount a bank has kept aside for all its gross non-performing assets. RBI states that a minimum of 70% of provisioning coverage ratio has to be there for the banks. Generally, the bank has to recognize its revenue when an EMI on a particular loan or advance falls due. But in case of an NPA, income with respect to an asset which has been classified as an NPA has to be recognized only on actual receipt of the money by the bank. So you've got a lot of information regarding the most talked term in money and banking, and if you find this informative, please like, share and subscribe to our channel. To test your knowledge, here is a model question and please comment the answers below. The answer, explanation and material of this current affair is provided in our Telegram channel. Click the link in the description to join our Telegram channel.